Peter Mcguire, CEO of XM Australia. Peter, you obviously watch China closely. It does incrementally appear that they do have some backbone on this stimulus campaign. They're not letting it go. The dogs keep barking on it. What's your thoughts on its outlook and its possible impact and into the new year?
Well, Sean, and greetings from Sydney. You know, when you're looking at it is a good news story, and you've only got to look at their stock market over the last year. You've got the Shanghai Composite up 16.5, and you've got the CSI 300 just shy of 19%. So it's not a bad rise. The market's inhaled it. It's up the best part of 1% today. So it hasn't shot the lights out to say, well, wow, you know, here it is. It's up 3 or 4%, but it's positive. At least it's green. And the overall growth momentum seems to have back engaged, and it hasn't really washed out too badly compared to where it was a couple of months back. It's had that continuation as far as bullish uplift. So whereas the China story, Sean, I think they're waiting to see what impact, again, building on Mukesh's statement, President Trump, only a 60% and possibly a 70% tariff that they're going to inhale. How are they going to manage that? Small to medium-sized enterprises are going to be crippled, and we know what the large ones are going to be like. It's going to be tough times. So I sit here and say, yeah, let's get on to the January 20 and see how this impacts markets, Sean.
Peter, just looking at the China outlook into 25 and the announcement today about the commitment to drive consumption, even if they are successful, Peter, and sustain their commitment to the stimulus plan, which is a lot of credit easing and so forth, is that likely to move the needle on oil consumption, oil demand? In terms of it doesn't appear to be targeted at the big industrial, the classic sort of Chinese build a railroad for 1,000 miles sort of projects, that even if they get the stimulus right, it may not move the dial on oil consumption. Your thoughts on that?
Well, you would think it would, Sean, just there would be organic growth. And when you're looking at this, I feel as though you'll get a better picture tomorrow as far as the depth of what they're trying to achieve. When we look at 25, there's no doubt that the Chinese engine internally needs to really gain some traction, and we're very conscious that I think that's the pathway forward. Naturally, from an export-driven model, it's going to be tough for them, and they've got to look at other markets. That's about a 16 or 18% export market goes to the US. The impact it's going to be is going to be quite severe for them from these tariffs. So they've got to do everything internally, gain momentum, and I would think that would be more consumption of naturally crude and more consumption of nearly all commodities. I mean, you've only got to look at their appetite, Sean, what they've done this year as far as gold. I've just made some notes. It's just unheralded. This in the last month, they bought 160,000 ounces of fine Troy, and they've over the last 2 years, you've got a whopping 10 million ounces that they've risen their gold consumption. So they're very focused on internal, I think, the internal engine. And they're probably not playing into President Trump's hand. They're playing into their own hand and other markets to really grow their economic, I suppose, vision towards Africa and very much other parts of the globe.
What do you think is their biggest sort of target in 25 in terms of their, obviously multitude of challenges that face every country and obviously faces China, peak population, peak other things. But is it deflation? How big an issue is deflation for the Chinese and for the world as a result in 2025, Peter, do you think?
I think deflation is very worrying, Sean. It's not inflation for China, but for a lot of other markets, it's certainly the inflation story that's going to be a handbrake to the likes of the Fed and other central bankers. Certainly in Australia, we haven't even had one rate cut as yet because of high inflation. And then you've got deflation moving into stagflation. And everyone knows from an economic theory, that's the danger zone. That's really peril. That's a frightening scenario to enter there. So where does China play? I think it's got youth unemployment to be a big concern, Sean. And again, what happens with their property market? That still is a property mess. That's still got to unwind all the debt associated with it, who's holding the debt. And we all understand that from Chinese banks and then global banks that are all making up the party as far as who's at the table from a debt perspective. So that's all got to work through, and you don't want to see I suppose, an aggressive stance forward with something like Taiwan to take focus. And what happens if we were to move into a more, I suppose, unknown geopolitical standpoint? If Iran enters something shortly, this could really see China involved there as well, Sean. So I think that the first quarter of 25 is going to be a very interesting one and very volatile for markets.
Peter Mcguire, XM Australia, your thoughts? I know you guys don't do forecasting, Peter, but what is your own sense? Oil prices averaging $80 on Brent this year. Do you think we'll be higher or lower than that in the next year?
I think two things, Sean. First off, I want to see how Q1 plays as far as from a geopolitical stance, and naturally with President Trump coming into power on the 20th, and where we could be on the cusp of something, and let's hope we're not, from a war perspective. And if something was to develop, then you could quickly see prices ratchet up, I think, from a geopolitical standpoint, and put a war premium in. And if things do materialize, then that changes, I think, everyone's footprint as far as a Q1 read. I think it's going to be that 60 to probably 80 handle. Unless you see something dramatic happen, I feel as though that with President Trump there, he's going to increase production, Sean, and so in turn they want cheaper prices. So yeah, I think it's probably erring on the side of probably closer to 60 than it would be to 80. But as you know, that's a wonderful, wild market to trade, and there's plenty of opportunity. So we could be well out on either side.
Well, we'll wrap it up there. And amongst the things that we can't forecast and the unexpected, well, there we go. China's policy stance could shift. There's confidence in this room that there's a dog, biting in that old dog head in terms of China. I think China, like they sort of everybody overestimated their performance this year. I think maybe the market is underestimating what they can do next year. But I think as a little anecdote for this sort of strange time we might be going into, as Mukesh started his comments, waiting for Trump, waiting for Godot. My son is at university in the United States, and as a foreign student who are off for the sort of winter, Christmas, New Year's season, they're all due to go back around January 19th. I think they're 20th or something like that. The new term starts, and they're being advised by their colleges to come back a few days early, just in case on the first day of Trump's administration, there's some bizarre executive order against foreign students coming from wherever in the world. I think there was examples of strange things like that last time. And so the actual university advised them to come early for that reason. That's one on a very long list, I think, of unusual developments that you wouldn't expect to have, but that's one of them. Thank you, guys. Jamie, Ingram, have a wonderful holiday season. Peter Mcguire and Mukesh Sadhep, thank you so much for all of your insights this year. We've closed up the podcast for the season at the end of this week, and we're back on January 9th for that 12-hour 50 market forecast across the world. We hope to see all of you guys on that and kick into the new year. Thanks, guys. Happy holidays.
Thanks, Sean.